Welcome to today's Heartland Market Talk on the Open Range Show. While the energy markets have been stumbling as of late, got down to the low $70 range, bouncing a bit now as we hear rumors of possible ceasefires, but even that didn't curtail a lift slowly occurring in the crude oil for 2 days. We hear that the Houthis again are trying to do damage in the Red Sea. Two ships were basically attacked by them, but no production has been lost on any ships being sunk, fortunately. But you're going to see more and more production moving away from using the Red Sea, and that includes oil. Grain freighters and dry freighters are going to be moving away, just increasing costs to consumers with that Red Sea and the Suez Canal being averted. Now, other news that is also supportive to the energy markets and commodities as a whole is that China is trying to pick up its economy. Since it was closed down for COVID for so long, even when it got renewed after COVID closed, the economy has just languished. And we're seeing the Chinese government trying to do things that are creating a stimulus to its country to get the raw commodity use picked up and their economy moving. Well, moving today to our Heartland Insights. We take a look at these charts. The first thing we review today is Thursday. We have a USDA crop report, and it's going to be about ending stocks. And as you'll note, these ending stocks, when we compare it to a previous year, our supplies have grown on the corn. As we roll into that report, our stocks are almost doubled, not quite on the corn supplies. Soybeans, though, we're just up 20 million bushels from last year on our current ending stocks, while the wheat also is higher by a little bit more of amount. We're up almost 78 million bushels year over year. These are estimates, and we'll see what the government wants to show us on Thursday. Now, world crop production is what's going to be more important, and that is what the USDA does for Brazil. Everybody's wondering how low they're going to come from last month's 157 million metric ton expectation for soybeans. The average guess right now is 152.5 million, with a lot of private guests, all the way down to 135 million metric tons, which makes this very important because right now this is holding us at bay from a price rise on the soybean market. Now, corn down from last month as well, 127 million metric tons. We're at 123.6 million. And note from last year, 137 versus now 127. So the drought has affected Brazil. The question is how much? Now, Argentina has decent weather as of late, to the point where some really think they're going to show an increase of expectation. Not enough to offset the Brazilian corn. Same thing goes with soybeans. Our production is up from last month, but still, total South American production can be off. This is important in the soybean pricing going forward, especially when we look at the world ending stocks. When we take the Europe, Asia, everybody into context, we do see from last year's, the USDA's previous number, we've drifted a little bit on the corn total overall. Soybeans will also be down, whereas wheat will be slightly higher. Now, how this is affecting a lot of other markets as we go forward. First, we're going to look at crude oil. We brought this to your attention last week. We are seeing a little bit of an uptrend on crude oil, as you note, that it has been stagnating here at the lows, and we're now seeing a push higher, which is holding at a trend line. But the bounce isn't much, and so we got to be concerned that oil prices may not be done yet with their winter lows, because even like last year, we had seen a December low. We tried to move higher into the December, February timeframe, and the market tumbled hard into March, as we had seen then OPEC step in and try to cut production, but still the market was stagnant well into May. So we're watching this here trend line. If crude oil starts falling below $70, we could be doing somewhat of a treat of last year, and we're going to see crude oil in the 60s yet before we get some kind of summer rally. Moving on to spot gold, we brought this to your attention. Now, the Federal Reserve is stalling and lowering rate cuts that firm the dollar up to well over 104 on the U.S. dollar, keeping gold at bay on the daily charts versus last week. Now, when we look at this on a monthly chart, you see how this 2,100 value has been major. A spike occurred back when Hamas invaded Israel, when we thought there'd be some world turmoil, but it remained contained, just Israel fighting Hamas. But for now, we are seeing gold looking for a reason to break out because it has not fallen off. It's almost like they don't believe the Federal Reserve that there is yet to be trouble and that the gold market will break out to the upside. Because as we've shown in the past, this trend line is strong support since the 2018 or 2020, 2019 has been a support at low that was made, and there is trend line support working in here. So you can see even if it tailed off to about the 1850, we'd still in this upward channeling on gold that believes the Federal Reserve is going to be acting, being very liquid on an election year, which will push gold prices even higher yet before the year is out. On soybeans, we had noted that the South American crop is in question. We've been in a large downtrend since November as rains did finally arrive to Brazil and stop the losses in Argentina. For the moment, looks okay, but as you'll note, this price trend has become quite heavy to the downside. A lot of players are stacked in, and as you find in commodities, it's not common for us to get these long trends without a reaction to the upside. So we do think, since we're getting to values that we're seeing last year for low, something is about to take place. The spring rallies like to get in the way of these downtrends, and we see a bounce could be coming on these soybeans. So we'd watch for that potentially here in the near term. Now, moving to today's Ask the Question. The question is, are the commodity futures markets more volatile than stocks? Well, first we got to state that when it comes to news stories, commodities and stocks act the same. Everybody has cell phones. They get news flashes for active traders on their phones, and they can react accordingly quickly with their trading apps, whether it's stocks or commodities. So that volatility is the same. On the aspect of your balance movement, most people pay for stocks in full, whereas commodities are all bought on the margin, and you're only putting down around 5 to 10% of the value of that commodity. So it's a big deal when stocks, when they move 10%, yes, your balance backs up 10%. But commodities, they can move just 1 or 2%, and you're going to see your balance move anywhere from 30 to 40%, depending on how much you fund that account. Some people put more than minimum margins required down, like for corn, for example. You can trade a contract worth $25,000 in corn, but only have to have $2,500 in deposit. Now, most investors probably would have anywhere from $7,000 to $10,000 for that one corn contract. But still, a 1% move in corn can move their balance already some 10 to 15% just because of this margin aspect. And that's where you get that terminology margin call, because stocks usually it's paid for. But when it comes to a margin call, you don't probably have enough money to take care of the underlying move of that commodity. So it's all a matter of perspective. Mostly commodities and stocks, they're about the same for volatility. Always remember, for more information, you can go to heartlandinvest.com, which is right on the front page of our website. And if you go to the website, you can sign up for our newsletter, which comes with morning text information on what's happened overnight and heading into the day session, along with afternoon recaps of what's happened. And we also, for those that need, we have trading advisories on what to do. Also, don't forget, it's insurance sign-up month for revenue insurance. We have our division, Heartland Diversified Crop Insurance Agency, which offers advice on which programs to take, along with livestock risk protection. And always, we have our daily podcast where you can catch up on what's happening in the markets. Thanks for watching.